Historically, financial advisors have turned to bonds for their risk-averse clients who are searching for higher return than bank CDs. However, has your advisor told you about the risk in owning bonds? I would just love to live in a perfect investment world. I would be able to find for my clients an investment that had all three of the following: high returns, high liquidity, and low risk. Regrettably, in this imperfect world, you can't have all three. Many retirees are seeking investments that still provide a nice return for their money. But here's the rub. If you want to increase your returns, you basically have two choices. You can either increase risk or decrease liquidity. Many investors, in an attempt to increase their returns, buy bonds. The biggest risk in bonds is that of interest rate risk if you don't hold your bonds to maturity. To illustrate this concept, let's return to the playgrounds of our youth. When we were children, we would play on the teeter-totters. When we clambered aboard, the teeter-totter was parallel to the ground. Similarly, at issue, the price and interest rates are at equilibrium. In this example, the issuer will receive $1,000 for the bond in exchange for paying a 4% interest rate. On the date that the bond matures, they will pay $1,000 to the bondholder. Between the issue date and the maturity date, the teeter-totter will go up and down according to interest rates. There's an inverse relationship between bonds and interest rates. In the past few years, we have seen what happens to bond values when interest rates fall. Bond prices increase. That is why many bond investors have made money in the past few years. The problem is what happens in a rising interest rate environment. I remember playing on the teeter-totter with a not-so-nice friend. When I was at the top and she was at the bottom, my friend decided to play a trick on me and jumped off the teeter-totter. All of a sudden, I came crashing to the ground. Ouch! The same thing can happen with a sudden rise in interest rates. If interest rates rise, then you can lose money in your bond portfolio. Now, I do not have a crystal ball and cannot predict the rise and fall of interest rates any more than I can predict the rise and fall of the stock market. However, if you have a large portfolio of long-term bonds, it might be a time for a review. If you'd like the chance to meet with me to discuss your particular financial situation and some of the strategies I've helped other clients with, please give me a call at 480-503-0050.
This has